Mistakes to avoid. Protect your capital from day one. As you step into multifamily investing, it's just as important to know what not to do as it is to know what to do. Many beginners lose money not because the investment was bad, but because the mistakes were avoidable. Here are the biggest traps and how you can avoid them from day one. Mistake number 1. Chasing deals without a strategy. Some beginners look at every property they see, hoping one will feel right. That approach leads to confusion, delays, and poor decisions. Instead, set your buying criteria early. When you know exactly what a good deal looks like, your path becomes clear and focused. Mistake number 2. Trusting pro forma over reality. A pro forma is a projection, not a guarantee. Many new investors make the mistake of believing the future numbers without checking the current ones. Always verify the actual rent roll, actual expenses, and the building's true operating history. Decisions should be based on what the property is today, not what someone hopes it might become. Mistake number 3. Underestimating expenses. This is one of the most common errors. Beginners overlook maintenance, turnover costs, insurance increases, and property management fees. Healthy multifamily properties typically run with a 35% to 55% expense ratio. If the numbers look too good, they probably are. Mistake number 4. Ignoring the market's supply pipeline. A city might look fantastic today, but if 10,000 new units are coming online, rent growth could slow down. Always check how much construction is underway. Markets with steady demand and controlled supply tend to deliver the most consistent returns. Mistake number 5. Overleveraging. Taking on too much debt can turn a solid investment into a fragile one. If your debt service coverage ratio, DSCR, drops too low, you'll feel pressure during vacancy dips or rate shifts. Smart investors leave a cushion and stress test their deals with different scenarios. Mistake number 6. Skipping professional management. Many beginners try to save money by managing the property themselves, but without experience, this often leads to poor tenant screening, delayed repairs, and lower occupancy. A good property manager protects your cash flow, your time, and your investment. Mistake number 7. Getting emotional real estate rewards discipline, not excitement. Don't rush into a deal just because it feels like a breakthrough. Don't overpay because someone else is bidding. Stick to your underwriting, your thresholds, and your investment principles. Avoiding these mistakes can save you thousands of dollars and years of frustration. When you stay focused, data-driven, and disciplined, multifamily becomes one of the most reliable vehicles for building long-term wealth. And that wraps up this 6-part series. You now have the foundation, the strategy, and the confidence to take your next step in multifamily investing. Ready to take the next step? Begin your multifamily investment journey today with Value Plus Capital.